What's up, everybody? My name is Joseph Brown, and this is Hair C Financial. Today, I'd like to discuss the fact that we are currently in the middle of the worst employment numbers that our country has ever seen, and yet the market is rallying. This has led many to question, why is the market going up? We have the worst employment numbers this country has ever seen when you consider the size, the magnitude, the extent, and the speed at which these things have happened. Why is the market rallying? That's a great question. I'm glad you asked. Let's dive in. On Friday, the markets were up, seemingly in response to some of the worst employment numbers that we have ever seen in this country. In fact, Neil Kashkari of the Federal Reserve, he came out on Thursday night and he said, look, the numbers that we're going to see on Friday are bad, but they're probably severely understating how bad the numbers really are. He said they're absolutely horrible. And yet the market is going up. And so it's led many to wonder what is going on when fundamentals are deteriorating quickly. What is justifying anybody, any significant amount of money to be piling to stocks right now? Well, there's a couple things at work here. The first factor that is at play here is the fact that markets are forward looking. And so there's increasingly bullish sentiment, especially on the stock markets, not necessarily the economy, but there's bullish sentiment in the stock market because we're getting closer and closer to states all over the nation opening up again for business. And so there's speculation that, hey, we're going to see a surge in business activity come in. And so money is forward looking. If something is guaranteed to happen in the future, it will happen right now. It won't happen in the future because you're going to place that bet in expectation of it happening in the future. If it was guaranteed that the stock market was going to fall 100 points tomorrow and everybody knew that, everybody would sell today to try and get their money out in expectation of it fall tomorrow, try and get their money out ahead of time, and then it would fall really fast until it got there, or even if it overshot. If it overshot though and people knew it was only going to fall by 100, then everybody would pile back in until it settled out there, meaning that markets are forward looking. Anytime there's a really solid expectation of something happening in the future and that's widely accepted, the consensus agrees, the money is going to push the prices there. And so there's sentiment, the wide consensus right now is that the fundamentals that are coming in the future, not the ones that are happening right now, the fundamentals that are coming in the future are justifying the higher stock prices. The second factor that's driving the markets higher right now has a lot to do with the weighting of the indexes actually. The performance of the stock market indexes like the Russell 2000 or the S&P 500 or the Dow, they're largely driven by the largest and the top companies in those indexes. And so you could see if you looked at most of the companies within an index, you could see that their performance is lagging or even going down, but that's not going to drive the overall performance of the entire index. It's going to be driven by the largest players in the group. And the consensus estimate comes back in here to play again when looking at companies like Amazon, that is a huge driver of the overall market. The current crisis is bullish for Amazon. Lots of people are ordering things online. And so you have factors like this in play where you can have a lot of companies doing relatively average or poorly, but a few companies outperforming everybody else so much that it actually drives the whole index up, even though that's no reflection of the economy. And again, this is really important to understand. There's a huge disconnect from the stock market and the economy now. The fundamentals in the economy are deteriorating and they are very, very bad right now. A lot of the pent-up demand that people are talking about is not really pent-up demand. It's permanently lost, permanently gone forever. Nobody's going to see enough movies to make up for all the movies they missed during quarantine. Nobody's going to go out to eat enough times to kind of make up for all of the times they didn't eat out. That's lost revenue, that's lost business, that demand is gone. All of the Uber drivers that depend on driving people around for a living, nobody's going to take more Uber rides on a weekly basis than they did before to make up for what they didn't do during quarantine. And so the fundamentals of the economy are bad, but that's no longer driving the stock market. And that brings us to the biggest factor that it looks like is affecting the stock market, and that is monetary policy. Historically, when the government wants to spend money, they're going to do it by two different ways. The first way they'll do it is they'll raise taxes. And so they'll take money from your paychecks, and then that money they will decide how they are going to spend that, and it goes back into the economy. And so they take a little bit from everywhere, and then they redeploy it into areas that they see fit. Classic redistribution of wealth, redistribution of resources, redistribution of assets. The second way that the government classically classically will spend money is by borrowing to spend that money. And so they'll issue debt. They'll say, hey, everybody, we want to borrow money. So we're going to issue treasuries, and anybody that wants to buy a treasury is going to loan us money. And so again, it's extracting wealth from the economy through a loan and then redeploying it, again, as they see fit. It's a redistribution of assets. Over the past few decades, a lot of the money that we have borrowed has actually come from overseas. It's been foreign central banks and foreign investors, foreign countries that are loaning the dollars to the United States. And so when you're borrowing money from other countries and you're issuing treasuries and they're held by other countries, you're not extracting money from your own economy, and so it looks like you have this magical new injection of cash. But that can't last forever. And in fact, in 2014, 2015, central banks around the world stopped on net buying treasuries. They stopped on net loaning money to the US government. And so that meant that new injection of cash from other countries ran dry. And so then you get to the third way that the government gets resources to spend, and that is the Federal Reserve printing money. And so the government will issue debt, but since there's no new lenders willing to lend that money to the government, the Federal Reserve has to print money out of thin air and loan that money to the government. And it goes through a couple steps. There's not a direct link between the two, but essentially that's what's happening. The new money gets printed. It goes to purchase the treasuries from the balance sheets of the primary dealers who have purchased those treasuries from the United States government at auction. And so following the money, the new money printed by the Federal Reserve is making its way directly to the Treasury, in essence loaning newly created dollars to the government that they are then injecting back into the economy, spending as they see fit. And so at this stage, you're no longer redistributing resources, you're creating new money. And so at this stage, once the Federal Reserve is picking up all the slack and doing all the lending, that becomes extremely inflationary because it's no longer just redistributing wealth. It's no longer redistributing purchasing power. You're actually creating new purchasing power, but it's not getting evenly distributed. You're locally assigning it and specifically assigning it to the areas that you see fit. So military contracts, Social Security, Medicare, Medicaid, big healthcare industry, government employees. These are all the areas that benefit from continuing to keep all of the resources that were just redistributions before, and now they're injections of actual new money that's being created and pushed into the system. There's no deflationary withdrawal of assets through the borrowing of assets from the people or the taxing of assets from people. You're just creating it out of thin air. And so there's no deflationary force to offset the inflationary injection of capital. Let's bring it back around. Stock market's going up even though the economy looks bad. Why is that? The economy looks bad, and so the government feels it needs to intervene to try and fix things. So the government is doing massive spending programs in order to do helicopter money, bailouts, unemployment checks, paycheck protection programs, loans and grants, direct handouts, pay raises for Congress. And it's all being financed through new money that's being created. As that new money is created by the Federal Reserve, funneled over to the federal government, and then it's injected into the economy, that new money is hitting asset prices first, like it always does. That's the Cantillon effect. When new money is created, it hits asset prices first, and it benefits the asset holders, the wealthy. And so you get into this really weird effect where anytime something bad happens for the overall economy, the solution by the government is then to go and do some spending to try and fix it, but that spending is inflationary and it goes directly to asset prices. We have this weird dichotomy where the worse the economy gets, the better the stock market is doing. And then you get into a situation like a crack-up boom, where in order to support asset prices, they continue to have to print new money because the entire system is now dependent on the prices of the assets, like the treasuries staying at the elevated and artificially high prices, and you wind up with an inflationary crack-up boom before the collapse of the confidence in the currency. So I hope that helps. I hope that wasn't too confusing. I hope it provides a little bit of clarity into why asset prices like the stock market are going up and treasuries are staying the same. There's no yield spike in treasuries right now because all the new money that's being created is making its way first into asset prices. And that's a direct result of the bad economic numbers that are coming out, especially unemployment numbers. If you enjoyed the video, hit that like and subscribe button. It really helps me out with the YouTube algorithms. Let me know if you have any questions or thoughts in the comments below. You guys have a great day.